Good day, investors. This is Roxanne Jane P. Capascio of RSE International, and I will be discussing about the international flow of goods and capital, as well as forecasting foreign exchange. This will be the objectives for this discussion: define capital flows, differentiate inbound from outbound capital flows, compare the positive and negative impacts of inbound and outbound capital flows to an aggregate economy, and also discuss foreign exchange forecasting. What are capital flows? International capital flow is defined as the stream of financial capital in monetary funds that travels freely between nations in an open global economy. These funds are invested in interest rate accounts and other assets that are connected to financial investments component of a capital account. Financial investments refers to the purchase of foreign and domestic financial assets, which can include stocks, bonds, or any other interest-variant accounts. When countries openly trade, domestic investors who are looking to earn money on their investments are free to invest in foreign assets, just like foreign investors are free to invest in domestic assets. The purchase of these assets represents the flow of financial capital between open economies. Inbound capital flow happens when foreign investors purchase domestic assets, injecting monetary funds into the domestic economy. When a country can offer higher real interest rates than any other nations, it will experience an inflow of capital as international investors rush to deposit their money into its assets to earn higher yields. Meanwhile, outbound capital flows is when a country experiences domestic investors purchasing foreign assets, which drains monetary funds from the domestic economy. When a country offers lower real interest rates than other nations, it will experience an outflow of capital as domestic investors rush to deposit their money into the assets of foreign nations in order to earn higher yields. Now let's compare the impacts of both inbound and outbound capital flows. Since capital flow is connected to financial investments in the capital account, inbound capital flow will cause a country's capital account to move towards a surplus, while outbound capital flow will cause a country's capital account to move towards a deficit. Meanwhile, inbound capital flow will also increase the volume of loanable funds available, while outbound capital flow will decrease the volume of loanable funds available. Inbound capital flow will also cause the supply of money in the domestic economy, which will stimulate investment spending by firms and lead to real GDP growth, while outbound capital flow will decrease the supply of money in the domestic economy, while also reducing the investment spending by firms and lead to real GDP contraction. Inbound capital flow will also increase the value of domestic currency in the foreign exchange market, while outbound capital flow will decrease the domestic currency in the foreign exchange market. However, inbound capital flow will also cause demand pull inflation, combined with an increase in consumption and the appreciation of the country's currency in the forex market. This will also drive a country's balance towards a deficit as domestic consumers purchase more imported goods and services. While for the outbound capital flow will also cause deflation combined with a decrease in consumption and the depreciation of the country's currency in the forex market. This will also drive a country's current account balance towards a surplus as domestic consumers purchase fewer imported goods and services. To further compare the impacts of inbound and outbound capital flows, inbound capital flows decreases unemployment of an aggregate economy, while outbound capital flow increases the unemployment rate of a certain economy. The inbound capital flow will also increase its income and consumption levels and improves the country's standard of living, while outbound capital flows decreases the income level and consumption levels and reduces the country's standard of living. Also, for the inbound capital flow, the demand pull inflation will cause a country's price levels to increase as well as raise its export prices in the open global economy, while outbound capital flow deflation will cause a country's price levels to decrease as well as it decrease its export prices in the open global economy. Also, for the inbound capital flows, as the country's currency appreciates in the foreign exchange market, imported foreign goods coming into the country are cheaper for the local consumers. This will cause net exports to decrease in the country, which will move the country's current account towards a deficit, while the capital account moves towards a surplus. While for outbound capital flow, as the country's currency depreciates in the foreign exchange market, imported foreign goods coming into the country are now more expensive for the local consumers. This will cause net exports to increase in the country, which will move the country's current account towards a surplus while the capital account moves towards a deficit. Forecasting exchange rates. An exchange rate is nothing more than a price. That is, the price of one currency in terms of another currency, and so they can be analyzed with the tools of supply and demand. Why do firms forecast exchange rates? So we have 6 reasons why firms do forecasting of exchange rates. First is hedging decisions. Next is short-term financing decisions. We also have short-term investment decisions, capital budgeting decisions, also long-term financing decisions, earning and also earning assessment. Forecasting techniques also will include technical forecasting, which focuses solely on past prices and volume movements, not on economic and political factors. The most common technique of technical forecasting is charting. Next, we also have fundamental forecasting, or also called fundamental analysis. This type of analysis is based on the fundamental relationships between economic variables and exchange rates. So it includes inflation rates, national income growth, change in money supply, and other such macroeconomic variables. The third technique is market-based forecasting. It uses market indicators to forecast exchange rates based on the concept that the market indicators efficiently incorporate expected future currency change. Corporations can use the spot rate to forecast since it represents the market's expectation of the spot rate in the near future. And that's it for my discussion for today. Thank you for your time, investors. Now I will give the floor to the next part of our webinar session for today.